If you are self-employed and you are contributing to a regular IRA, you are using the smallest retirement account available to you. The solo 401k, also called the individual 401k or the I-401k, lets you contribute up to $69,000 per year. Every dollar you contribute reduces your taxable income for that year. For a freelancer or consultant earning $150,000, the right contribution strategy can legally reduce their federal tax bill by $15,000 or more annually. Most self-employed people have no idea this account exists, or they think it is too complicated to set up. Neither is true. To qualify for a solo 401k, you need two things: self-employment income and no full-time employees other than yourself and your spouse. That covers freelancers, consultants, independent contractors, sole proprietors, single-member LLC owners, and small business owners with a spouse as a co-participant. You do not need a formal business structure. You do not need a separate business bank account, though having one is good practice. If you have a side hustle that generates Schedule C income alongside a W-2 job, you can still open a solo 401k for the self-employment income. The reason the solo 401k allows such large contributions is that you are wearing two hats, employee and employer. As the employee, you can contribute up to $23,000 in 2024, the same employee contribution limit as a regular 401k. As the employer, you can make an additional profit-sharing contribution of up to 25% of your net self-employment income. Those two numbers added together give you the combined limit of $69,000. No other retirement account available to an individual allows this combination. Here is the math for someone earning $100,000 in net self-employment income. The employee contribution is $23,000. The employer contribution is 25% of net self-employment income, after deducting half of self-employment tax, let us say approximately $18,500 in this example. Total contribution, $41,500. That $41,500 is deducted from your taxable income. In the 22% federal bracket plus a 5% state tax, that is $11,200 in taxes you do not pay this year. The money is still yours. It is just growing tax-deferred in the account instead of going to the IRS now. The solo 401k also comes in a Roth version at most providers. With the traditional version, contributions are pre-tax. You deduct them now and pay tax when you withdraw in retirement. With the Roth version, you contribute after-tax dollars, and withdrawals in retirement are completely tax-free, including all the growth. Some providers allow you to split, make part of your employee contribution as Roth and part as traditional. The right choice depends on whether you expect your tax rate to be higher now or in retirement, a calculation worth doing with the CPI. Opening a solo 401k is straightforward. The major low-cost providers, Fidelity, Vanguard, Charles Schwab, and TD Ameritrade, all offer solo 401k accounts with no annual fees. You fill out their application, provide your business name and EIN. You can get a free EIN in minutes at ers.gov, and your account is typically open within a week. The critical deadline: the solo 401k must be established by December 31st of the tax year you want to claim contributions for. You can fund it up until your tax filing deadline, including extensions, but the account must exist before year-end. One frequently missed benefit: the solo 401k allows loans. You can borrow up to 50% of your vested account balance or $50,000, whichever is less, and repay yourself with interest over 5 years. This gives you access to your retirement savings in a genuine cash emergency without the 10% early withdrawal penalty that comes with pulling money from an IRA. The loan provision makes the solo 401k a more flexible emergency backstop than many people realize. If your self-employment income varies significantly year to year, common for freelancers, the solo 401k is more flexible than a SEP IRA. In one key way, you can choose to make zero employer contribution in a lean year without penalty. The employee contribution is also discretionary. You have full control over how much you contribute each year based on your actual cash flow and tax situation. There is no minimum contribution requirement and no penalty for contributing nothing in a given year. Once your solo 401k balance exceeds $250,000, you must file Form 5500EZ with the IRS annually. It is a simple one-page form that takes about 20 minutes. Below that threshold, there is no annual filing requirement. This is worth knowing because some people avoid the solo 401k out of fear of IRS paperwork. But for most self-employed people in the first decade of using the account, there is literally no reporting obligation beyond your regular Schedule C. If you are self-employed and you do not have a solo 401k, open one before December 31st of this year. The account setup takes less than an hour. The tax deduction can be worth more than $10,000 in a single year depending on your income. This is the most straightforward, highest leverage tax move available to self-employed people, and it is systematically underused. If you want to pair this with the other major tax strategy most business owners leave on the table, one that creates tax-free income using a space you already own, our video on the Augusta rule covers the exact setup and what the IRS requires. Sheltering income is only half the picture. If you want the other side of the self-employed equation, how self-employed people handle Social Security goes further. It explains why the income you choose not to report today quietly shrinks your benefit for life. It is on this channel.